In the last video, we looked at price retracing into internal range liquidity and then continuing in a normal way towards your take profit. What happens when context changes? Well, it can actually make more sense to just take an early exit on your trade because ultimately the context has shifted and we don't want to just sit there and wait for price to just trade into our stop loss. So we're going to explore exactly what an early exit is, when to take them, and what the actual impact on your trading strategy is in the long run. So let's quickly look at a definition. An early exit is a deliberate decision to close a trade before your stop loss is hit because the context your trade was based on has changed. So it's not about being emotional, it's just systematic. What it is not, so panic closing because price is just retracing. Ultimately, a retracement respects structure. Context changes destroy your original thesis. So if your original trade thesis is dead, why hold a trade that is probably just going to go on and hit your stop loss? So let's take a look at what we looked at in the last video and just reframe it slightly. This is a context change in motion. So in a normal retracement, we're holding into this internal range liquidity. We had buy pressure, which sold through, creating a fair value gap and an order block. Price retraces in, respects the internal range liquidity, then trades away. What this looks like is something different. Price does the exact same thing, but it closes through the structure, creating new order flow in the opposing direction. Well, if this happens, and it happens around a higher time frame level, this is cause to take an early exit on your trade, and then that gives you the capability to take a new entry in the opposing direction. So what to look out for? Around higher time frame levels. So higher time frame candles sweeping the manipulation candle low. So if we have accumulation, manipulation, distribution, you're expecting distribution to the low of the accumulation candle, but price is doing this at the low of the manipulation candle. Your manipulation candle can become new accumulation that is being manipulated. So this is a sign of a reversal. Structure shifts again against your position. If you're seeing price creating new order flow or market structure shifts against your position, this can be a sign that you need to get out of your trade. Internal range liquidity being fully mitigated, not wicked through, but actually closed through with conviction. So that's exactly what happens here. We see bullish candles printing and closing in this internal range liquidity. Ultimately, what that creates is inefficiencies in price that create the order flow that price can react from to go higher. This is all around higher time frame levels, and I'm going to bring this to life on the chart and then show you the impact of getting out of trades early. So let's just imagine right here that you are playing something like this, where we have a sweep in this 2-week candle range of a previous 2-week candle range. So we are swing traders, so we're looking at 12-hour execution. Price printed this bullish monthly candle, but it's not actually finished printing at this point. So I'm just going to take that away. We get this very bullish 2-week candle range. Price then pushes above, closes inside the previous candle range. So what is happening? We have accumulation, manipulation. Now we're potentially expecting price to sell off to the range low down here. But what actually ends up happening is that price starts to trade off and then eventually takes off in the opposing direction. But without this context, imagine we are joining price here. We have this 2-week candle range. It closed below its previous candle range. It's also coming off this manipulation. So we have a bearish price leg where we have the last buy to sell and we have fair value gaps in the actual price leg. So we have the order block here. Then we also have an inefficiency in price right here, and this is bearish. So what we might expect to see is price wants to trade in a normal retracement and then continue lower towards this draw on liquidity at the low here. The context being we've swept this entire candle range, we've printed a bearish 2-week candle, we have bearish price action. So we're expecting normal retracement continuations. But what actually ends up happening? We see price aggressively move into this structure and close with the formation of a new order block here. So right here at the low, we have the last sell to buy, and we also get the formation of a new bullish fair value gap right here. So we have context shift. Where is this context shift happening? It's happening at the low of a previous 2-week candle range. So without actually looking at the higher time frames to see if this is something that we want to get involved in, just by looking at what's happening with these 2-week candles, these are two decisions that we might have made. We may have entered a short right here at this order block on the assumption that price is going to trade much lower. So this could be a 4+ R trade. However, what we see is that price then aggressively moves against us, and you see it closes deep in our drawdown. So at this exact point here, when we see this candle close, we're roughly 50% into drawdown. But at the same time this candle closes, we get the formation of this bullish internal range liquidity. We're also sweeping this low. So this is where an early exit can now make sense, because instead of just holding this trade, because we don't know if price is going to retrace at this point or whether the next candle is just going to smash through our stop loss, we can just close the trade. We're not closing a full 1%, say we were fixing our risk at 1%, we're just closing 0.5% because we're only halfway in to our drawdown. So we close that at a minus 0.5 or half of our original expected loss on the trade. That's an early exit. That goes out the window. But what this then allows us to do is to assess with a fresh view. So what then we can do is think, okay, well, we're getting a structure shift at this low. Maybe we now want to trade continuations. So we can enter from the fair value gap, even add a relatively conservative stop, potentially just below the swing point here, and then trade back to the high, 3.38 R. So that plays out perfectly. It takes quite a while for price to get there, but that is a context shift whereby we took an early exit and now we are playing the reversal trend. Now that makes sense, and it's something to an extent we've covered before, but this is where it gets very interesting. So if we come back to our slides here, how position sizing builds edge. Well, we talked about this a couple of videos ago, where let's fictitiously imagine we have a 10K account. We're maximizing or fixing our risk at 1% with a 2.5 R target. Previously, 40% win rate drove us an £800 profit over 20 trades, because we lost 12 trades and we won 8 trades. We're fixing our risk at £100. We're losing 12 times £100, £1,200. We're winning 250 times 8 trades, which I believe was £2,000. There it is. Now, let's just imagine the exact same scenario plays out, but instead of taking a full 1% on those 12 positions, we managed to get 4 break-evens because we saw that structure was shifting against us. We set our stop to break even. We got out at break even. We took 4 haircuts, similar to what we just looked at, where we closed out for maybe a 50% loss. So instead of losing a full £100, we just lost £50. So instead of losing in these 4 trades £400, we've lost £200. And then 4 times we just didn't get the opportunity and we got stopped out for our full £400. Well, the total loss there is now £600, but we still won 8 trades. So instead of making £800, 8%, we've now made £1,400 or 14%. That is a massive, massive change on our return. And again, if we then scale this up with things like prop capital, we're looking at a 200K account. Instead of making, I think it was 16K, we're now making 28K. And that is just by understanding when to get out of trades before they hit our stop loss. And that is the power of understanding proper exit management. We're now going to look at this in even more detail on the next video. See you there.